Morning routine, focusing on strategy, not the market. A long-term investor does not open charts first thing in the morning, does not check intraday price movements. Instead of asking, "What happened today?" asks, "Has my plan changed?" The System 1, System 2 thinking model introduced by Daniel Kahneman is especially relevant here. Daily price movements fast, emotional reactions, System 1. Strategic decisions slow, analytical thinking, System 2. A long-term investor consciously tries to remain in System 2. Do they track daily prices? Most successful long-term investors do not monitor daily price changes, filter daily news flow. For example, Warren Buffett has repeatedly stated that he does not focus on daily prices, but on the value of businesses. His approach: a stock equals ownership in a business. If the company's fundamentals have not changed, price fluctuations are just noise. The news diet. One important habit of long-term investors is limiting information consumption. Because too much information, too many triggers. Too many triggers increased urge to trade. Research by Vanguard shows that investors' biggest performance losses often come from poor market timing decisions. That's why many long-term investors limit exposure to economic headlines. Stay away from social media investment hype. Read annual reports instead of daily commentary. The real daily routine. Focus on life. The most important routine of a long-term investor is simple. Keep generating income. Because the fuel of long-term investing is consistent cash flow, regular savings. Research shows that most wealth is built not from high-frequency trading, but from staying invested over long periods of time. Historical data from the S&P 500 demonstrates that time in the market is more important than timing the market. Weekly/monthly mini check. A long-term investor may not check daily, but periodically reviews portfolio allocation, risk balance, alignment with goals, cash flow, and asks one key question: has my strategy broken down? If the answer is no, nothing is done. Psychological discipline routine. A long-term investor manages FOMO, fear of missing out, learns to stay calm during market downturns, avoids making decisions during panic. Behavioral finance research shows that an investor's biggest enemy is often their own behavior. Therefore, the daily discipline includes protecting oneself from market noise, avoiding off-plan trades, consciously reinforcing long-term thinking. A typical day of a long-term investor. Morning. Focuses on work, not the market. During the day. Does not rush into new investment opportunities. May engage in financial reading, reports, books. Evening. Avoids unnecessary financial content. May review strategy in writing, but does not check the portfolio 10 times a day. Make impulsive decisions influenced by social media. Common traits of great investors. Warren Buffett, Charlie Munger. Shared habits. Extensive reading. Minimal trading. Patience. Discipline. Their daily routine is driven not by action, but by thinking. The most critical truth. A long-term investor does not spend time watching the market, but building their life. Real gains come from compound returns. Behavioral consistency. Patience, not constant activity. Conclusion. The daily routine of a long-term investor is filtering out noise, protecting the plan, generating income, saving consistently, monitoring sparingly but consciously. Ultimately, the greatest routine of all is learning to do nothing.